On January 6, 2025, the Indian stock market witnessed a sharp decline, with the BSE Sensex and the NSE Nifty experiencing significant drops. This downturn was not isolated, but was influenced by a mix of domestic and international factors that converged to shake investor confidence. Below is an analysis of the multifaceted reasons behind this market plunge. 1. Weak corporate earnings. The market was jolted by disappointing Q3 business updates from major banks like HDFC Bank and IndusInd Bank. These updates highlighted concerns over subdued loan growth and the impact on the broader BFSI sector, leading to significant sell-offs in banking stocks. The second reason was healthcare scare from the HMPV viruses. Reports of human metapneumovirus cases in India sparked a knee-jerk reaction among investors. Although the virus's impact isn't expected to match that of the previous pandemics, the initial fear of a health crisis contributed to market nervousness. Rupee depreciation. The Indian rupee weakened against the US dollar, influenced by both domestic economic concerns and a stronger dollar globally. This depreciation often signals economic instability, prompting foreign investors to pull back their investments. The fourth reason was the FII selling pressure. Continuous selling by foreign institutional investors was observed, driven by the lure of better returns elsewhere and concerns over slowing Indian GDP growth. This was exacerbated by the anticipation of a volatile US market post-Trump's inauguration. The fifth reason, global economic indicators. Rising US bond yields and high dollar index are indicative of a shift towards safer assets, negatively affecting emerging markets like India. The anticipation of US inflation data and its implications further unsettled the markets. 6. Sectoral downturns. The downturn was broad-based, with sectors like public sector banks, metals, and realty leading declines. The Nifty PSU Bank Index saw significant drops, while sectors like IT managed to outperform, though not enough to offset the general market slide. 7. Economic growth concerns. Predictions of India's GDP growth dipping below 6% for FY25 have led to a re-evaluation of market valuations, with investors pricing in subpar growth and weak earnings, which in turn pressured stock prices. 8. Oil prices. Rising crude oil prices globally have implications for India, a major oil importer, potentially fueling inflation and impacting corporate margins, thus affecting stock market performance. This confluence of factors created a perfect storm on January 6, leading to one of the most significant single-day drops in the Indian stock market, reflecting both immediate reactions to health and economic news and deeper concerns about the trajectory of India's economic growth. Looking ahead, the trajectory of the Indian economy and its stock market hinges on several critical junctures. The immediate aftermath of the market downturn on January 6 suggests a period of heightened volatility where investor sentiment could swing based on forthcoming developments. For the broader Indian economy, the concerns over slowing GDP growth, rising oil prices, and potential health crises like HMPV will require vigilant management. The government's response, particularly in terms of fiscal policy adjustments, infrastructure spending, and health sector preparedness, will be pivotal. If these are addressed with foresight and agility, the economy might regain its growth momentum, leveraging India's structural advantages like a young demographic dividend and increasing digitalization. Corporate earnings begin to show signs of stabilization or improvement, particularly in key sectors like banking and finance, will then probably indicate towards a recovery. Other factors for potential recovery would be if the RBI adopts a more dovish stance to stimulate economic activity, or if there's clarity on inflation control, or if the global markets stabilize, reducing the outflow of foreign capital and perhaps even reversing it. However, challenges remain. Persistent high valuations might cap the upside in the short term, especially if earnings don't catch up to the market expectations. Continued geopolitical tensions or further health crisis could introduce additional volatility. The direction of global interest rates, particularly from the US, will significantly influence FII behavior towards Indian equities. Investors might be wise to keep an eye on policy announcements, especially around the upcoming budget, for cues on economic strategy. In the stock market, there could be a shift towards defensive sectors or stocks with strong fundamentals as investors recalibrate their portfolios in light of the new economic realities. Ultimately, the strength of the Indian economy and its markets will be tested by how well it can navigate these multifaceted challenges while capitalizing on inherent strengths. The key will be adaptability, not just in policy making, but also among businesses and investors as they navigate through what remains an unpredictable global and domestic landscape. This is a news analysis for Destiny Communications.